Hey guys, Brian Stevens here with the National Real Estate Post. Remen, the Real Estate Mortgage Network, wants to let you know that they host a broker show intended to help brokers out with their business. If you want to check it out, all you have to do is click this banner right over there. So everybody, sorry for NAM, but some personal stuff came up, and even if I could go, I couldn't go. See, I tried to send my ops guy in my Steed, and every flight to Las Vegas, every flight was canceled. This flying stuff right now is out of control. So, word to the wise, if you're going to fly anytime soon, plan on an extended stay and bring a pillow. See, I just had a 20-hour flight from Atlantic City to Sacramento. 9-hour layovers, they really help, but enough contravening from me. Let's talk shop. First, and this is a big story and one that we broke before. We told you this a few weeks ago, but the CFPB is going down the road of equalizing rules for depository originators and non-bank loan officers. See, non-bankers write the vast majority of loans. Frankly, the big banks don't even have a stomach for writing loans right now. There's too much punitive risk in this whole thing. But here's the thing. You guys write the most loans, but you barely, if at all, participate with bond loans, varying down payment assistance, and zero participation with the Community Reinvestment Act. Now, why is that and what is that? The Community Reinvestment Act, the CRA, is a law intended to encourage depository institutions to help meet the credit needs of the communities in which they operate, including low and moderate income LMI neighborhoods, consistent with safe and sound banking operations. Now, if you didn't catch that, they said depository institutions meet the credit needs of low-income folks. Now, there's a multitude of ways that we can do this, including putting these in a portfolio in your company, loans that are high risk for poor people. That sounds great, doesn't it? Tell me, does your company have the net worth to fund and hold on to, say, $500 million in high-risk loans? Now, before you kick me in the ass on this thing, low and moderate income loans have a history of being high risk, much higher risk of default than the average loans that you're writing. So I'm not playing cavalier here, I'm just stating the facts. We also talked about this a couple weeks ago. The FHFA is calling for better practices related to the sharing of regulatory information about the performance of mortgage companies and others that work with Fannie Mae and Freddie Mac, the GSEs. So what does this mean? The FHFA is encouraging Fannie Mae and Freddie Mac to start looking at suing you for practices that are not aligned with the current administration's belief on what the GSEs should stand for. So what does that mean? Well, the story we just went over. Non-banks are going to need to start representing underserved communities and low-income borrowers in a much more meaningful way. Now, this sounds like the impossible job to me, as low-income folks simply can't afford to buy homes right now at their current prices. So what can you do about it? Well, the thing is, doesn't matter if folks in your area can't afford homes, you need to find a way to make your HMDA and your ECOA look like how Fannie and Freddie want it to look, or you're going to find yourself on the short end of an ass whipping. Let's just put it this way. The changes being made right now with the regulatory agencies, HUD, the GSEs, and the FHFA are about as organized as the withdrawal from Afghanistan. You want to get on one of the planes first, you want to be an early adopter of these rules, or you might just get left behind. Finally, the Freddie Mac 30-year fixed rate averages at 2.99% at 0.7% cost, meaning rates are once again below 3%. Thank you, COVID. Now, let me ask you this. Do you really care? As a mortgage loan officer, do you care where rates are at any given moment? Here's an idea. Here's a graph of interest rates from 1970 to today. You can see here, rates went up to 18% and people still bought homes and refinanced. So here's my thinking. Worrying about interest rates is just a distraction. It distracts you from your job at hand. And that's a way to find a way to bring more loans in the front door of your mortgage company. See, if people bought homes and refinanced homes when rates were at 18%, it doesn't matter if rates are at 2%, 6%, 3%, 8%. Don't let the minutia move in interest rates distract you from your highest and best use of your intellect. And that's closing deal. Hey guys, thanks a lot. It's nice to see you again. Just watch out if you get on planes. It's a real pain in the ass right now. Why don't you forward this and share this on your social sites and keep the conversation going, because you never know, there might be a deal in there.